So to move us on, we're going next to our panel on equity and investment. And I'm sure a lot of you have been looking at a lot of surveys the last couple of weeks. We had the Scale Ireland survey just weeks ago, which was looking at nearly 300 founders of startups here in Ireland. And what that was showing was that really 4 in 5 of those respondents for Scale Ireland were saying that their biggest problem right now is accessing capital in the current environment. You see also just 2 days ago the William Fry report, which was talking about a slight downturn in mergers, acquisitions, probably inevitable given that 2021 was such a boom year, but to see that little downturn. And then we had the IVCA report, which is our Venture Capital Association here in Ireland, and then kind of coming out the back of 2022, there was definitely a flattening in terms of that international investment that we were drawing in, and really looking at potentially that squeeze middle. Lots of seed funding, Series A is still happening, but is there something happening in the messy middle, those companies that are out building the products and services, trying to find their route to market? What is happening for them? So to ask questions like that, to look at valuations, down rounds, deal terms, and the approach to deals, I'm going to ask our speakers to come up, and then we'll pull up a poll for you. So this next panel is going to be chaired by Anne Harkin, corporate partner, Mason, Hayes Curran. Hi, Anne. The rest of you, as you hear your name, just come on up. Hugh Lloyd, managing director, Arma Partners. We've got Alan Foy, chairman and co-founder of VentureWave Capital. We've Colum Lyons, founder and CEO of ID Pal. We've Conor O'Sullivan, investment director at Atlantic Bridge. And we have James Ives, founder and CEO of XOCEAN. Thank you so much, everybody, for joining us. Please give them a round of applause. And as they take their seats and get settled, we have 2 poll questions for you, so you can start zooming in on our QR code. We'll keep this poll open throughout this next session. First question, are the terms demanded by investors in 2023 too investor friendly? And it's a simple yes or no in your poll on the event app. And the second question we'd love you to take a look at is, are the founders and the investors of your business aligned on the funding and investment strategy? And again, a yes, no. We'll keep those 2 poll questions open, and we'll give you the results at the end of this session. Anne, take it away. Thank you.
Great. Thank you, Anya, for those introductions, and good morning, everyone. As Anya mentioned, the theme for our discussion this morning for our panel is fundraising for tech companies in Ireland. And we have a great range of perspectives on the panel, from advisor to investor to founder come investor. So it's going to be a great discussion. And I suppose the topics that we're going to cover are the general themes that have arisen in conversations around fundraising for tech companies, given the challenges that we faced in the past 12 months. So we'll look at things like valuations, down rounds, extending runway, enhanced investor due diligence. We'll also touch on what are the options when it comes to funding for tech companies, and we'll also hear from our founders and get their perspectives of running a business and growing a business during these more challenging times. So there's a lot to discuss, and we don't have a huge amount of time, so I'll jump straight in. And I suppose, Hugh, valuations, there's been a lot of talk on valuations in the past 12 months, and I suppose it appears that there was a slight reluctance on the behalf of management and founders to accept the lower valuations that were being placed in their business during 2022. And I suppose now that we're into 2023, how are you seeing that sort of gap in expectation play out? Is there perhaps a more realistic expectation by founders in terms of valuations for their businesses?
Yeah, look, I think time is a big healer. Valuations certainly got very high in late 20 and 21. I think if you look where valuations now are, they're probably back at sort of 18, 19 levels. So certainly not bad if you look through history. But when founders and management teams had seen either raise money themselves at a very high valuation, which creates problems, down rounds, and we can come on to that, or they'd seen, friends, competitor companies raise it high, it was hard to accept that the world had reset sometime. I think there's now a sense of realism, and people are looking at the alternatives, which are maybe more structured rounds, which have problems in themselves, and so maybe you're better, taking the pain now and continuing to grow your business from now, having taken on the finance that you need.
I suppose, Alan, same question to you. What's your perspective?
Yeah, well, first and foremost, to say one thing. First of all, good companies will always get funded. That's the first thing. And unit economics are absolutely essential. If you're a good company, you've got good unit economics, you're going to attract positive investment. There's no doubt about that. The fact of the matter is we did have this period of time where you could actually raise valuations well north of what you could sell your company for in the M&A market. And that's just a fundamental mismatch. So what we're seeing right now is actually hopefully a leveling and an equilibrium and that crossover between fundraising and M&A and what happens in the real market where you get cash for your company. So I think that's all positive. There is a fixation, incidentally, on valuation, on headline valuation terms. And we in the investment profession and also those who are, I'm a poacher turned gamekeeper, as you mentioned earlier on. I was an entrepreneur, I did fundraise, and I'm now an investor. But I recognize that a headline valuation means nothing. It's really deal terms. And actually the effective valuation. So we'll get onto that, I think, later. But fundamentally, I think we're at a point where you look at companies, we're seeing the kind of large public companies, they're being repriced. We've seen the NASDAQ down 15% over the last year, up 10% year to date. That's a bit of a releveling. That sends positive indicators. That macro funding environment at that larger, later stage business has flowed down into Series D, Series C. This morning we saw apparently, Stripe have had another reprice in their valuation to 50 billion this morning. So we're seeing that, and it is affecting earlier stage companies. But at the end of the day, there is a wall of capital there still to fund growth companies with the right economics. Will we see failures? Yes, we will. Will we see growth and large capital raises? Yes, we will. That's a functioning market, so it's a good thing.
Thanks, Alan. And Hugh, you mentioned down rounds, and I mean, down rounds and the thought of down rounds have caused people a lot of angst, and I mean, no more so than lawyers as they pore over their drafting of previously unread anti-dilute provisions. But I mean, in practice, have you seen many down rounds happen, or what are companies doing to avoid down rounds?
So certainly through the last year, I think the mood was try and do everything to avoid a down round. I mean, I'd be interested in the legal view, but I think that can create problems in itself. You saw, extreme structures coming back in, so sort of multiples of participating preference, yields, things that become instruments that become increasingly debt-like in their looking at, and that creates their own problems. So I think actually having your latest investors a lot more aligned with you as a founder and a management team, and indeed your earlier investors, probably doesn't create so many problems down the line. So look, ideally it's something you want to avoid, and we were talking about time and moving on. We're now I think further into this reset, and maybe even seeing valuations ticking up slightly. And for good companies, that's maybe given them time to grow. So yes, multiples have come down, but maybe they can achieve even that flat round, which probably makes things a lot easier. But our attitude is, although on the face of it, it's not great to take down round, it often can be worse to try and sort of paper it over with complex structure, etc.
And Conor, in that context, and I suppose for your portfolio companies, what are you advising them to do, not necessarily to avoid down rounds, but to kind of extend their runway and control cash burn, just given the kind of difficult environment that we're in for fundraising?
Yeah, just to sort of, I'll address that question as well, but just to comment on the previous answers. I think there's a bit of a nuance around early stage and late stage. We're a multi-stage, multi-geography investor. Right from the early stages, where I spend most of my time on teams who are spinning out of academic institutions in Ireland and setting up businesses. I would say there's much more stability there, and we see still some very strong pipeline of companies coming out of those institutions, which is really positive. And lots of deep technology that's coming out of years of research. So there are still strong valuations, but they're probably more stable than the later stages. We're very focused in our own portfolio on supporting our management teams to ensure that they have sufficient cash runway to meet their milestones. For any company that's not hitting their milestones right now and is going out to market, it's very challenging. no matter how good the team, because everyone wants to see that progression and how have they done against their plan. So there are various measures, including looking at staffing and how many people do you need in the business. What are you doing around R&D activities that may not be core to delivering on those next goals to raise your next round of funding? Could you potentially defer them, cut them back? And of course, talking to your existing investors about pushing, getting yourself another 2 or 3 quarters of runway to ensure that you hit those milestones and put yourself in the strongest position that you can to get out to the market and meet new investors. So all of those things combined, we spend a lot of time with the management teams to make sure that they have a plan and that they are executing on all of the objectives that they set themselves. So that's what we're focused on right now.
And I suppose James and Colum, we're talking about plans and things that founders can do or companies can do to extend their runway. And I suppose it's one thing making a plan and then the actual reality of implementing it and continuing to grow and scale your business. How have you found that in the past sort of 12 months and given those challenges?
Yeah, I think, look, as a business, we've a tech business, but I come from a financial background. I've never been a real believer of revenue at all cost. And myself and Conor were talking about a company this morning who 12 months ago raised, 100 million. I'm well aware within the market what they're doing is they're trying to buy a lot of deals, and now they're going out for a bridging round of 20 million. That's not sustainable. So for me, it's all about creating that sustainable business, that consistent revenue growth for your business. And again, you have to look at the difference between a company that's scaling and comparing the likes of the types of companies I'm involved with to the Googles and the Facebooks and this 10% reduction of staff. So, but you really got to be looking at all your costs every month. It's no longer appropriate to be looking at it on a quarterly basis just for your board meetings. So you need to be really honing in on every single bits of your costs, managing your expectations, and if you're not hitting your revenue milestones, you need to pull back and make sure that you have that runway for the future.
Thanks, Colum. Same question to you, James.
Yeah, so very similar. I mean, I think with every business, you need to have a good handle on your cash runway. You need to make sure that runway is long enough. And I think within the business, you always have levers. And you look back 18 months ago, and it was all about growth. It was all about revenue. It didn't seem to matter about profitability. Maybe we're in a more sensible place now where actually profitable is actually important. In a business, you've got levers. You can pull those levers to slow down and maybe a bit on the growth so that you put more into your EBITDA. So I think as a business, you just need to understand your business, understand that cash runway, and then manage it most effectively.
Thanks, James. And I suppose maybe if we move slightly off valuations for a minute and look at the deals that are actually going through and the terms of those deals, I suppose, Hugh, in the past 12 months, the term sheets that are coming across your desk, what are you seeing now that you wouldn't have seen, going back 24, 36 months?
Yeah, look, as advisors, we're principally engaged when the focus is going out and raising new capital. And, our financing practice did less volume last year and consciously. And a lot of our advice was now is not the right time for you to raise. I think, you will face the issue of a potential down round or having to have a lot of structure. So I think there was a lot of investors stepping up and doing bridging rounds, convertibles, whatever, to help them through. And I think there should be credit to investors. Yes, they'd come in the good times, but I think a lot of them did step up to help companies. And I think founders and management teams have to recognise that and actually make those changes, make the tough decisions that our founders on the panel here have talked about to try and get that path to profitability and extend that runway. Rounds that did require new investors, as I said, I think the level of structure was coming in, and I think one of our panel questions is about, have terms got to investor friendly? I think when you start getting these, multiple prefs, et cetera, I think arguably they have, because I think actually what you want to have is as much alignment as possible in your cap table, and back to James's point, I think you want to think about what is the full terms of a deal, not just that headline valuation. And I think people are thinking about that a lot more But I think we should get back to a sensible place. Yes, rounds will take longer. Yes, investors are probably pushing for more structure, but that's something you can push back on and part of your negotiation, and maybe you should take a trade on price to get simpler terms.
So would you say that, I mean, if things go back to maybe not necessarily 2021, but pre-2021, or a lot of those terms that we're seeing, I suppose, in the last 12 months, is that going to fall away? Like if we go back to a frothy market, will it be back to sort of, quick acceleration from term sheet to deal closed? Or do you think that there's some sort of learnings from what's happened that might, become more commonplace now going forward?
We're in a market that's a bit boom and bust.
Yeah.
So there's no going, and that's great if you're on the right side of that. But I think you have to be realistic when in the boom times and pragmatic where they won't last forever. So look, I would say it's going to be a while before we get back to 2021 levels. And I think if we've got a couple more years history and we plot that on a chart, we'll say there was some anomaly going on there. We can already start to see that, obviously. But I'm not going to say we're never going to get that, because fundamentally I'm a big believer in fantastic entrepreneurs that are disrupting industries and can build amazing companies, and there will always be investors that are excited to get into those businesses.
Thanks, Hugh. And I suppose to Alan and Conor, from our perspective, we've seen enhanced level of investor due diligence and kind of a more steady pace as you go through from diligence to executing documents. From your perspective as an investor, I mean, how has your approach to deal making maybe changed in the past 12 months?
That's a good question. I think there's a couple of things I'm thinking as we're talking. One, I met a very seasoned US investor, and he said that the VC community is basically making sure they have enough schmuck insurance in place on all their deals. And I think that's a feature of a lot of the structures we're seeing. I think it's absolutely correct. I think from our perspective, it is about diligence. It is about buying into the growth plan. It is about sustainable growth. That's kind of charts the course. From a VentureWave perspective, we're trying to basically align with founders and in the point of understand what the founders' kind of end game is and structure the deal to meet that. And then obviously on the diligence piece, we have a job of work to do through our advisors, the great advisors like Mason, Hayes and Curran, to bring through that process. And it's absolutely vital. That's our kind of responsibility as a fiduciary. But fundamentally, you have to have belief in the entrepreneur, belief in the plan. None of that changes. And I think what I'm seeing at the moment, unfortunately, and we meet a lot of companies, as you can imagine, every week, I'm seeing two types of entrepreneur, if I can generalize for a moment. One is those really, really kind of sustainable-minded entrepreneurs who are focused on the future, who have a plan, who are checking in, not raising just yet, keeping the relationship, so active interaction. And the second part, you're seeing, unfortunately, companies and entrepreneurs who have very little runway and cash burn come at us. So obviously, from a diligence perspective and a process perspective and a deal-making perspective, those two types of entrepreneur dictate which path you're going to go if you're going to do the deal at all. So I think, where do I see the market going from a deal perspective? I see, unfortunately, in the marketplace, VCs, and they're a great breed, most of them, but very few of them want to lead. So we're always being asked to lead because no one else wants to lead. No one else wants to be the first schmuck in the room. So absolutely, you'll double down on protections. You'll double down on your warranties and refs. You'll double down on where you think the potential risks are. And you'll try and square them away as much as you possibly can in deal structure and obviously legal docs.
And do you think, you're saying you're double downing now, like again, same questions I put to you, if things pick up again in 12, 24 months, do you think any of that kind of enhanced sort of diligence or more cautious approach will remain if we go back into what we've seen in 2021?
I think it will, and I think it should.
Yeah.
At the end of the day, we had large international VCs, and I hate to call out Tiger, I hope there's no one from Tiger here, who literally issue a term sheet. You have 2 days to accept a term sheet, do no diligence, not put a director on the board, and here's 100 million. That's crazy. That is just gold rush. That's mentality. It's just wrong. Yeah. So if that overcorrection back to kind of steady, do the diligence, protect your investors' money, understand the alignment of the plan and work together ends in a sustainable business and a sustainable relationship, it's a good thing.
Yeah. I suppose, Conor, your perspective on that as well.
I mean, some of our diligence going into companies spinning out of Irish universities can start 12 to 18 months before we actually invest in, before they actually become a company. So we spend a lot of time with the academics and bring in commercial teams. So we have the benefit of seeing how those journeys develop over a significantly longer period of time than so some of the other investors that may be coming in and doing a short amount of due diligence. So I think that's incredibly important. And just as Alan said, that's your fundamental transaction process. You have to learn as much as you can about the company, because the founders know much more than you do as an investor, and you need to get up to speed as quickly as you can. And having a longer period of time to do that and spend time with the teams we find is incredibly important. I think in terms of a funding cycle, maybe the venture industry rule of thumb was you'd raise to get you 12 to 18 months, and then you'd be out again and hopefully closing another round of funding. That's in today's world too short. We're probably seeing rounds being structured for very strong, good companies, 2 years plus of runway. That also means, depending on the size of your fund, bringing in other investors into your syndicate earlier. And as you said, Alan, international funds and other funds look to local investors to lead, and it's our job to bring them into the fold and also build out syndicates early on, because I think that's important from the founder's perspective, the company's perspective, and other investors as well, to have others around the table. So we spend a lot of time working with large international-based funds that, to be honest, are still very, very interested in what's going on in Irish tech, and particularly Irish deep tech. We're getting a lot of inbound interest about our portfolio, and we'll continue to see that increase. So those rounds of funding are being structured such that they are longer, because you need to build in some buffer in this market.
Thanks, Conor. And if I can maybe now turn to our two founders on the panel. I mean, you've both gone out to the market and raised funding in the last 12 to 24 months. And I suppose from your perspective, what were the key challenges that you encountered in that process? Or do you want to talk just a little bit? Because I know we have a good few entrepreneurs in the room that would be interested in that perspective.
I think just a little bit about our journey, I suppose, in terms of the funding. So we got our pitch deck together, we got our 70-80 page investor memorandum together, we got our data room together. So we had everything ready, prepared before we actually went out to market. And the week before we went to market, we emailed all our current investors to let them know that this is what our plan was, this is what we're doing. I got a phone call the next day. 3 days later, I was in that person's office from one of our current investors, and we shook on the deal sheet, right? So it was very, very quick in that regard. So a little bit of a Carlsberg moment for the company in that regard. But to the guys' points about due diligence, so they still got an independent, even though they were investors in the business for the previous 4 or 5 years, they still got independent tech due dil, independent financial due dil. So there was a lot of heavy, and that's probably where the frustration is, right? Is that you're going through that. But I think something that a founder or executive team need to realize is that even though you're going through that, it's actually for the benefit of the business. Mm-hmm. So, and to your point, good companies will always get investment, they will. So you shouldn't have anything to hide, you shouldn't be hiding anything. But there's probably things that you will learn from that heavy due dil. And even if you don't learn it, it'll allow you to question your business on certain things and go, are we doing this right? Are we doing that right? So I think the frustration is probably, you shake hands on the deal sheet and the money comes in 5 months, 6 months later. But, I think you have to do those things. And I think it's a benefit, obviously, to the investors, but also it is a benefit to the business as well.
Yeah, and I suppose, James, XOCEAN isn't your first rodeo, so you have a lot of experience under your belt when it goes out to, looking for money and the challenges that comes with that. Do you want to talk about that a little bit?
Yeah, I mean, the thing I would echo, I mean, the one thing that's always been a consistent is that it always takes a lot longer than you ever hope, and investors will always say, oh yeah, we can close this round next week, add about 3 months to that and you're probably in the right space. But I think that's always been the case. I think there's always been that issue. I think, interestingly, obviously, VentureWave are investors in our business. So, and actually for us, our investment journeys, we started primarily bootstrapping this business for the first couple of years, really maximising the use of other sources of funding. So Enterprise Ireland are fantastic for early stage businesses. There's things like EU grants that you can secure. So there's a lot of non-dilutive funding out there, and there's a lot of access to sort of capital that really helps those early stage businesses. But then you move on to the sort of the more formal process. And I think really, the one thing I would really echo there is that I think you learn a huge amount about your own business by going through a funding round. You get some really, really smart people like Alan and his team asking you really difficult questions and really probing the business, the fundamentals of the business. That's only a good thing. I've always felt that companies come out much healthier after that process, albeit it takes you away from the business for a long time, and it could be pretty hard graft for a long, extended period.
And you touched on their EI and bootstrapping, all the different ways that you can kind of fund the business without going out. I suppose, Colum, what's your, you've recently gone out. What do you see as the main options for tech companies at the minute if they're going out looking for funding?
Yeah, I think it depends again on where you are in your life cycle, whether you're a startup, a scale up, or you're in that kind of B round, C round, D round. From my experience, it's been from the very much startup. So obviously EI are investors in ourselves, competitive startup fund. 50 grand for a PowerPoint slide, to fulfill your dream of this is the business that we want to build. But obviously you're going through that journey, and you more than likely have your angel investors, and then you move into that VC world as you move up in towards your Series A. But there's obviously debt financing as well from that side. One thing I think that a lot of companies forget about is the best funding is new customers, right? And there's so many people that are putting so much time and so much effort into speaking to VCs and speaking to investors, and they're taking their eye off the ball of what would actually happen if we put that 6-9 months into actually trying to get customers. And then you have more money, you have more revenue, you have better terms. Now, granted, that might not be possible for every single business. You might have to get regulated before you can start generating revenue. And the other thing I would say is crowdfunding. So a lot of companies forget about the crowdfunding option as well. I know Spark Crowdfunding in Ireland are doing a great job. They've done 40, 50 deals in the last couple of years. You need to be a sexy business to do some crowdfunding. Anti-money laundering, our business is not sexy, so it didn't appeal from that side. But there are a lot of options there, but it depends on your business type, where you are, what stage you're at as a business as well.
And Conor, do you have anything to add to that?
I think at the early stage, state supports are incredibly important, as you said, James. De-risking what are very high-risk technologies, deep technologies at the before they actually become companies, and academic research. Enterprise Ireland has been incredibly supportive of that, and the Irish government. Having spent most of my career in tech and startups in the UK, actually the environment here in Ireland is better in my opinion, and it's more supportive, and it takes bigger risks. That's fundamental to how companies get off the ground. And if you combine that then with equity investors as well, and you kind of supercharge those earlier stages of a company, particularly with respect to the size of funding rounds. So I think that's a very good positive combination that we can be very thankful for here in Ireland, and hopefully that will continue and increase.
A brief mention of debt there, obviously something at the later stage, but we're seeing a lot more sort of venture debt coming into rounds. I think as maybe there's a bit more pressure on valuation, people think more about dilution. And you should remember that actually giving away a part of your company as a founder management team, this is the most valuable thing that you give away. And yes, sort of venture debt type terms is expensive in debt terms, but it's not as expensive as equity. Now, I'm not suggesting you should, over put too much on your business, but it is something that we're seeing more people look at when they raise money. Maybe they would have just gone out to raise 50 million. They're now saying, maybe I'll do 25 of equity and 25 of some sort of debt instrument, and therefore it might be at a slightly lower valuation, but from a dilution perspective you can work it better.
Thanks, Hugh. And I suppose if we just talk about the outlook, short to medium term outlook. I mean, before this morning I did a quick Google search of some of the key terms here. So if you put into Google raising capital outlook 2023, I mean, the range of headlines from even the past 7 days go from plunging valuations continue to hammer the industry to it's 2021 all over again. So I think, you know, the sentiment and opinion out there about the outlook for fundraising landscape in the tech sector, just it's very varied. So, you know, be interested to get everyone on the panel's perspective. Next 12 months, what do we see happening? Alan, I'll start with you.
Well, I think again it comes back to macro. So what's happening at a macro level? I think macro it'll be more turbulent and more volatile. I think still a little bit this year. I still think it'll end well. I think this year will end well. So I think that macro effect will affect pension funds, asset allocators, LPs, feeds into VC, feeds into the, you know, you have to think of it in terms of almost like the water down the hill. You know, it has to come from somewhere. So I think that you will see a bit of a rebalance. My sense is that the later stage businesses that don't yet have that kind of path to IPO or sale, they'll probably have to endure a little bit more pain, I would suggest, in this year. We're definitely seeing, to Conor's point, seed and early stage is still buoyant in the States. Like even like yesterday, I read a report that in the Bay Area, valuations and asset and allocation to seed is higher than it was last year in this quarter so far. So I think we have to kind of, segment the market a little bit. My sense is, unfortunately, we will see, I hate to say this, and I know Hugh doesn't agree with me here probably, but there will be some pain this year. We will see some companies go bust, run out of cash runway. And we'll see, hopefully, a lot of M&A as a result of that, and a lot of talent being acquired. So I just think we should embrace that. That might just need to happen. I think at the earlier stage companies, you will see more VCs stepping into lead rounds. I think you'll see more international money here, increasingly. So I do genuinely feel buoyant and confident that when we exit 23, we'll be in a much better place than we are now as a community. And I think ultimately what we do need, though, is we need successes. We need companies to trade and sell and exit and IPO. And I think that's the big challenge that we have in Ireland. I think it's one that we're all focused on. But I think we're getting there.
Thanks, Alan.
Absolutely. It's an ecosystem, and you need to have those successful founders and teams, management teams, who are coming back into the system and starting other companies and supporting new founders, and that's incredibly important. So I absolutely agree with you that I think it's that would be very, very positive for the Irish tech ecosystem if we see more of those M&As and exits happening. For the best teams with very, very strong competitive technology, these two teams that you see here in front of you today, and pathways to market, go-to-market plan, and good funding and good investors behind them, they will do well in 2023. So I don't think, for the best companies, I don't think too much has changed, albeit maybe expectations are different around valuations as we started talking about, and I think that's I think Alan's covered the rest.
Yeah, look, I think the biggest change you will see for high quality businesses is actually the time it takes to get done, back to the point of the level of diligence that's being done. So make sure you've got the runway. Really do your work up front that you feel use your existing investors, use your network to actually ask a lot of the questions that you'll probably get from investors, so you feel you've answered a lot of those questions. That makes you look a very impressive team, but hopefully it also does cut down some of the teams. It doesn't take you a week to scrabble around to get the data to answer those questions, but do prepare for it to take more time. But try and use it as a learning experience, use it as a step up. But we are seeing high quality businesses who've taken the time to prepare, really understand their business, have got a hold of their unit economics and have a story of how they're going to continue sustainable growth, raising at actually very healthy valuations. Yes, there will be businesses that go under. And if you're one of those strong businesses, and we're seeing actually more discussions around that creates an M&A opportunity. There was a time when there was no company that seemed cheap, because they'd just done a venture round at some very high price. Well, now probably the choice is doing some M&A or maybe sadly folding. So that is something to consider. But don't underestimate the pain of doing an M&A deal, even though I do M&A partly for a living, and the pain of integration. But if you have got to that stage where you're a mature enough business and you've got a big enough team that you're not all going to be distracted by it, I think that creates a big opportunity to grow market share.
Thanks, Hugh. Well, I think that just leaves us enough time for a couple of questions and to look at our poll results. Emma, they're probably going to be up on the screen. Okay, so are the terms demanded by investors in 2023 too investor friendly? Yes. So I think
I'd like to know who's in the room here.
Yeah. It's telling a lot about the audience today. Yeah. Is there another one? I think there was two. Are the founders and investors of your businesses aligned in the funding and investment strategy? Yes. So that's a positive message. So we have time for a couple of questions, and there's plenty coming in. So first one, I think this is really for Alan and maybe Conor. What's on the priority list for investors? In the past, it was total addressable market, founder experience. Has that changed?
That's a good question. Yeah, so I think ultimately, typically investors adopt an approach, or top-down, bottom-up, micro, macro. I think increasingly investors are actually trying to blend both and really doubling down on what are your KPIs, what are your churn, what's your retention, like almost granularly looking at your customer base and the performance stats of that sustainable kind of sales growth. And then also triangulating that with, well, where is the market? Where is the opportunity? Do we really believe they have product market fit? And trying to blend that appropriately. So I think you're typically VCs are either weighted a little bit one way or the other. I think they have to be both. And I think what you'll see now is more third-party analysis of, well, what is the stage of growth of the market? What's the opportunity? What are the threats? What are the kind of competitive landscapes looking like? Doing a little bit more diligence in that area, but then really going very deep on unit economics. And I keep on saying unit economics, good companies will always get funded, but it all comes down to your unit economics. And investors, particularly in venture, buy into that. Those unit economics expand at scale and produce positive cash flows ultimately, right? So that's, I think you're going to see way more laser sharp focus on that.
I think it's easier if you know your metrics and you know your unit economics, it's easier to actually map out that model. So, I think everyone has their 3-year, 5-year model, and people kind of question a lot of those models. But I think if you have your 2 or 3 years of customer base, you know what your churn is, you know what your uplift from customers are, it's easier to map that out. So it gives investors more confidence that, okay, they'll actually hit this. This is what they say they're going to do. This is what they'll do.
Great. So we've only time, we're over time. So we'll do one more question for Emma Reese me off stage. Is US funding culturally beneficial for Irish companies with ambition to scale? For whoever wants to take that question.
Alan, you probably...
I don't know how
you've been there and done that.
Yeah, well, a lot of our LPs are US as well. Look, at the end of the day, in the US, and I go there for a shot of energy a lot, the ambition and the scale and what is possible is just phenomenal. And at the end of the day, if you've got US investors in the mix with some, locally savvy, hopefully experienced Irish investors, well, that only can be a good thing. And your access to M&A, to deal flow, so I think it's all about ambition. At the end of the day, entrepreneurship is about ambition, it's about scale, it's about growth. And you want investors who are aligned to that mentality. So I'll always embrace a US investor in my business. I'll always embrace a US investor in my fund. And I'll try and get, if possible, a match of both local and international. So yeah, absolutely. And look, at the end of the day, Ireland is a great place, but our relationship with the US is a special one. It is the special relationship. And I think we should absolutely harness that and leverage it.
Thanks, Alan. And thanks to all our speakers, and thanks to everyone for listening. That's everything from us for now. Thank you.
Well done. Thank you, Anne and everybody.